There's an old saying, trade what you see, not what you think. Trade what you see, not what you think. That only works if you're looking at tools that are not random. If you're looking at tools that help you predict stack probabilities of what the hell price is going to do next. When too many people get long, it's hard to continue to go up. Market can't pay too many people. Doesn't work that way. So if a lot of people are long, that means price has to go up to pay those longs. Doesn't work that way. Too many people long, you don't want to be long. Well, how do you read that? Right in here, we get this number to go bigger on the right, greener on the right, mean more longs than shorts. And if I fast forward it, just look at that number right here and this delta, so to speak, 31, 38, just watch it. So you see it spread right there and stay spread. What does that tell you? Downside's right side. Before it goes down. Before it goes down, before it goes down. Because if it's not giving you a heads up, it's not a good tool. Then it doesn't matter you're trading what you see and not what you think, because what you see is irrelevant. If you're a meteorologist and they're showing you what the weather is and what the high and low pressure is in the UK, and you're trying to tell me if it's going to rain in Chicago this afternoon, it's irrelevant right now. What's going on over there? Why are we studying that data? So it's really now, if you were a meteorologist in the Chicago area and you didn't realize that what you are examining is irrelevant, then that is dangerous. Then you're going to have random predictions. Most people trade with random tools. So this is a moment where more people are long than short. When that's the case, it's bearish. Then you add to that we're on our highs. You add to that you have a head fake up to go down. Understanding what a head fake means, of course. Then you add to that some negative fundamentals that just came in the market in this particular day was what? The yen intervention. Not understanding that as an economist or a pundit, as a trader. That's generally negative for stocks. It's an inverted correlation with the yen. Yen goes up. Based on intervention, it's bearish for stocks. You don't even have to think about that when you know enough about fundamentals as a trader, not an economist. This was the high of the day. We ended up breaking all session long pretty much for the next hour. There was another big break. What time did I say? It was 9:45 was the next spike in the yen. And if you take a look at 9:45, it's going to key another more downside, at least keep you off the wrong side right in here. This break right in here. You could see it better on this chart. You can see all this downside was keyed off of a new move in the yen. And as I fast forward it, you could see there was still 10 more, 15 more points of downside. Now at 9:45, if you weren't aware that the yen's on fire, well, you're probably maybe picking a bottom and you're bullish for reasons that don't have a healthy step one. So it helps to understand what could be driving the market. Now, that might be irrelevant in 2 hours, but it's relevant right now. It might be very relevant over the next 2 days. Who knows? Understanding which markets are correlating and helping you the best for your market is part of a good community, by the way. Then there was another. What was the other? Better to change. Oh, this was just, I wrote down in my notes. Better to change your mind than change your underwear. I thought that was a good first time saying. When I come up with a good one, I got to write it down. I bring that up because today had a moment where the first 30 minutes or so, hey, they were bullish. You should have been bullish based on what everything was looking like. But you also need to be able to change your mind because it reversed. Didn't reverse because of a chart pattern. It reversed because there's some new fundamentals that came in at 9:07 Central. And it came in that There was an emergency meeting between Bissett, Treasury Secretary, and the Finance Minister of Japan. That's all. Keep it simple. That means it's going to go down forever, but it helped go from highs to lows. So you're not picked off all the way down on a move like this, like a lot of people get picked off. Why? Because they were bullish for the right reasons because of this. It's like marketing in an infomercial at 3 o'clock in the morning and the blinking lights outside the hotel, pumping oxygen into casinos, all the things that they do to market you. Well, the market is marketing you as well. So it gets you bullish. You have to know when it's also trapping you and creating too many what? Longs. Too many longs is one of the best bearish clues you'll ever have.